Okay. Okay, welcome everyone to our ANZO Trading Hub. And today we're going to be, today is going to be the first of many trainings where we'll be looking at, basically, the idea is to be more of a community where traders can learn to become better and even improve their trading skill sets irrespective of their level. So let's jump straight into what we have for today. So my name is Nana Obin-Alexander. I'm the Senior Market Analyst and Head Educator at ANZO Capita. I'm sometimes called the FX JEDI. I used to be Head Market Analyst and Educator, Senior Educator at Gemini Capital Markets and IV Markets. So I've been trading for, about 8 years now. And, I've learned a lot through the market. I've made a lot of losses and I've made a lot of money as well in the market. And the idea is to teach you the best practices and show you some of the things that have helped me to become even consistent as a trader. Okay. So what we'll run through today, this is not, this will just take about a few minutes on this part before, and then we'll see how we can do something with it. Okay. Now, a lot of you here are traders, right? I know you're trading, and trading is, quite interesting and quite nice. But many a times, it's usually a, one step forward, two step back, one step forward, two step back type of system where you make some money, you're happy, and then you give it back. And then you make some money, you're happy, you give it back. Sometimes you're making money, sometimes you're not. When you make some money, you lose more than you made. You're always wondering, why is the market always against me? Why am I not getting it right? Now, in many cases, the reason is down to us. In almost all the cases, we are at fault for that. And it's because we don't have a plan for our trading. And even if we do, we don't follow it. So I'll show you why it's important that you need a trading system. You need to develop your own trading system, have a trading plan, and then how to actually use it properly. And then I'll show you some example of that. And I don't care what type of trader you are. I know that there's this arrogance in the trading community where, for example, SMC traders, smart money type concept traders will think that their trading style is the best. And then let's say price action trader will feel that theirs is the best. And then people who trade news will feel theirs is the best. Now, there's no best and there's no worst. There's just your system. Now, your goal is not to look at what the other person is doing and see if you can do exactly what they are doing. Your goal is to build a system that works for you, right? And you can do that. It's just a lot of the time we're lazy. We want somebody to give us signals. We want just something that, oh, this is the holy grail to trading. And I can tell you categorically there is no holy grail in trading. You just need to define your system, backtest your system, and trade your system irrespective of what happens. Now, you can always look to optimize and make it better, but you don't change your system while trading, okay? So let's begin by looking at why you need a trading system. Now, there's an old expression in business that if you fail to plan, you're planning to fail. Now, everybody knows this, right? And we know that, well, if you want to run a business and you don't do due diligence, you don't draft the business plan, look at the balance, look at exactly how you get supply, where you get your stuff from, and how you sell them to supply, demand, and all of those things. You're going to fail as in that business. Now, the person is going to almost certainly fail if you don't do your due diligence to figure out what is needed to start a business. However, when it comes to trading, people feel that they can just wing it. They feel they can just do whatever they like and hopefully make money. I'm sure a lot of people here also might have tried to trade for prop firms. And in concept, in theory, it's quite easy. Just make 5% or make 10%. But when you're trading live markets, it now becomes like, it's as if the demo market is different from live markets. Well, the reason is because you don't have a plan that you follow. And then, you might know a number of strategies, right? So imagine somebody who is learning to fight or learning, is a kickboxer and, knows a number of moves, knows how to do flying kick and how to throw a jab and a punch, but doesn't really do anyone that well. What will happen at the end of the day is he will lose most of his fights. And that's what happens in trading. Now, if you ask any trader who makes money on a consistent basis, they'll probably tell you that, there are just two choices. Either you have a plan and follow it, or you fail. There's no alternative. You can wing it. You can just be scalping, not necessarily, even if you're scalping, you should have a plan and a system to it. But you can, just open your chart, you see the market going up and you buy with one standard lot. And fortunately for you in that occasion, it makes you $2,000. But you cannot do that every single time. And as a matter of fact, what will happen for those kind of cases, somebody makes 1,000 and is so excited, they think that they're the next George Soros, and then the next day they lose 4,000. And they're wondering what happens, why did it not work? That's because there is no plan. The primary aim of a trading system is to enable you manage risk and to increase your probability of winning. Now, I know we don't like to hear this most times, but when it comes to trading, there is risk. The trading involves risk, and you have to put that into consideration, because many times I see people trade as though they are sure that the market will move in a certain way. So imagine somebody who has, let's say, let's say $2,000 in their account, and decide to trade 10 standard lots or 5 standard lots or even 2 standard lots with no stop loss or even 1 standard lot. Now, you're trading as if you're sure that if you buy, the market is going to go up. Now, what happens is sometimes you buy and it goes up and you're happy and you make some profit. But then other times, most times you buy and, well, it doesn't start going up and then you're paranoid, you're scared. And you either sit there holding the trade and it goes to blow your account, or maybe you cut it and take a huge loss, and then eventually the market goes up in your direction and you're wondering why your village people would not leave you alone. Well, it's not their fault, it's yours. It's important to have a plan. So the first point is to have a plan if you're going to succeed in this business. Now, a plan should be a written document. It should be clear as to what you're doing, what the goal is, what the objective is, how you get into the market, how you exit the market, and a plan should be specific to you. So what that means is, what that means therefore is, well, my trading plan might almost certainly not work for you, and your trading plan might almost certainly not work for me. So many times you see people, here's the reason why I don't actually like signal givens, right? So you see those Telegram channels and a lot of those stores where they give you signals, buy at this price, put stop loss here, put take profit here. You don't even understand the plan behind the system. Now, somebody who is a high risk trader and is giving trading ideas, well, those type of trading ideas might not be suitable for somebody who is a low risk trader, or somebody who is a low risk trader. His trading ideas might not be suitable for someone who is a high risk trader. So understanding exactly where you sit and what changes, right? What suits your own system, what suits your own personality is key if you're going to succeed as a trader in this business. Now, somebody asks, so how do I define or design my own system? Now, the truth is, having a trading system is quite simple. It's all about defining, so what exactly do I trade? How do I trade it? How do I get in? And how do I get out? Now, once you've decided on what to do, what you want to do first is not to now trade it on live money or start trading it immediately. What you want to do is look at previous price action. So you want to back test it, right? And then if you're comfortable with the system's outputs, then you can forward test it and you can then forward test it and trade it in live market conditions. So it's a two-way thing. Actually, it's a three-way thing. So you have to define the plan. The problem is somebody goes to YouTube, somebody's teaching, Fibonacci expert trading system. And then they explain a very beautiful concept, which makes sense to you. But then you take the concepts and then you see a condition, live market conditions that seem to fit what was taught, and you immediately try to trade it, and lo and behold, it fails. And then the person goes, well, this thing doesn't work. And then you go to look at the next concept and you learn another trading strategy. You learn another smart money concept. Oh, I'm going to trade order blocks. I'm going to trade Y curve accumulation and distributions. And you have all of these several moving parts that don't fit together and don't really do anything. So at the end of the day, you have yourself sitting in a load of rubbish, actually, a lot of useful rubbish. Now, you might ask, why do they teach a lot of things? Well, that's because there are a lot of different types of personalities and a lot of different things that would be appealing to different people. Now, just in the beginning of this session, I showed you a comprehensive training module that I developed, from introduction to Forex to some of the introductory basis in Forex to some even advanced concepts. You see that there are a lot of even trading strategies. There are a lot of things I know and I teach, but I don't do. Now, the reason I don't do them is not because I don't believe that they work. It's just because I've defined a way that I trade, right? I'm sure you know a lot of ways to make money. You can find a job, you can sell items, you can go into constructions. You know a lot of ways to make money, but you choose one or two to focus on, and that would be your income source. In the same way, you might know lots of systems or lots of strategies, but doesn't mean you want to now trade every system, because it's like penny wise, pound foolish at the end of the day. So you want to have a system or define a system, and then to backtest it. So you define a system, you backtest it. If you're okay with the results, then you can now start trading with it. You have to trade a system long enough, right, before you discard it. Now, at some point, you might need to discard a system. Maybe market conditions have changed. For example, I'll say in the past, few years ago, when we trade the news, I used to trade the news, right? The way the news report affects the markets 3 years ago was very different from the way the news report affects the markets today. I understand that market conditions have changed, so the system doesn't work as well anymore. So I discarded it. Another example would be, I used to trade the London Open, right? So I used to trade GBP pairs for London Open. And then 2-3 years ago, there was a very good system. Like it was very nice. I would trade GBP CHF, GBP JPY, GBP Aussie, and GBP NZD. There was a way the market functioned once the London Open starts. And a few years ago, for almost a year, every morning I'll capture like 60 pips across all of these pairs. And it was nice. Now, it's not guaranteed. There are some days the market doesn't do that, but that's still part of the system. Now, the goal of developing a trading system is not to find a system that doesn't lose money. In Forex, you will lose money. So what I mean is you will make losses, right? You take a trade and it will go and hit your stop loss. That doesn't mean that you need to change the system. That's the problem I have. So somebody is, oh, this is your system, lost money, or this my trading strategy is not working again. For the last 3 times I tried it, well, it's lost me money. And who told you you're supposed to win every single thing you trade? That's not the way the market works. Now let's take, for example, you have a system that has a win rate, right? So you have a system that has a win rate of about, let's say 70%, right? So let's say you have a system that has a 70% win rate. Now, a 70% win rate means that you're losing 3 out of 10 trades. So you take 10 trades and you lose 3. Now, most times when people think about it, they imagine that it means you lose. So you win the first one, you win the second one, you win the third one, you win the fourth one, you win the sixth one, you win the seventh one, and then you lose the last 3. When we think about win rates in this function, we like to think, oh, we win and then we lose. Or even a 50% win rate, you might think it's okay, it's a win, lose, win, lose, win, lose type of system. But that's not exactly how it works. You might have a 50% system that is profitable, at least based on your back testing. It makes you money, let's say 60% of the time, 50% of the time. The first 5 trades might be losses. So you might have loss, 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 and then you have the next 5 to be wins. Now, does that mean the system is flawed? No, it doesn't mean the system is flawed. It just means that you have to, in your trading plan, you have to account for the fact that you will be wrong. And this is where risk management comes in. For most people, if this happens, they will just cancel the system and say, this thing doesn't work. And you know what will happen? The next time they see it, they will not trade it. And that will be the one that will end up becoming profitable. And they'll be wondering why they keep picking the wrong trades to trade. Well, the answer is you don't know which one will be wrong. You don't know which one will be right. What you can do is have a system and a defined way of trading such that once the criteria are met, you execute your plans. Now, it's okay for me to just rant about having a system, and it doesn't make sense for me not to show you how to build a system, build your own personal trading system that can assist you become better, okay? So one of the key things when it comes to building a system is the time frame. So you have to figure out the type of trader that you are, right? It's actually quite important. Now, how do you figure the type of trader you are? Look at yourself. Think about how you feel when you place trades. So if you take trades, what do you expect? Are you looking to make profits within minutes? Are you okay holding trades for a long period of time? Are you okay? Do you like to open a trade and close it within the same day? All of this will tell you, okay, it seems I prefer to scalp. Okay, I prefer to day trade, or I prefer to swing trade. Now that's one way of figuring out the type of trader that you are. Another way is also to figure out how much time you have to look at the market. So for instance, you might like to be a scalper. You want to sit in front of the chart and scalp all day long. Or maybe you have a day job, and your job, you have to, let's say you work at the bank. Well, you can't actually be trading while you're doing your job. You get fired. So maybe you only have time to trade at the night. So maybe because of the time you have to trade, it means you have to probably be a day trader or some sort of a swing trader, right? So you figure out what time frame you want to watch, what time frame you want to trade within, and then that was the first basics for building a system. Now you can build a system, you can build multiple systems, or you can have a system where if I'm looking to day trade, I trade based on these rules. And if I'm looking to swing trade, I swing based on these rules, right? Now, are you a day trader or are you a swing trader? Are you a scalper? Once you decided on exactly how you want to trade, next point will be, okay, so how do I look for opportunities within the time frame that I'm more comfortable with, right? And even if, irrespective of the fact that let's say you're a scalper and you prefer to look at the 5-minute chart, that doesn't mean that you ignore the higher time frames. As a matter of fact, higher time frame is what moves the lower time frame. So you have to keep the higher time frame in perspective. You have to keep the higher time frame in focus because it's essential. So once you've decided on the time frame that you'd like to trade, the next point would be to add, if you know me, for some of you who know me, who join my classes, who've actually been taught by me, you know that I'm a trend trader, right? So basically, so what I mean by that is I've seen a lot of people, right? Over the years, even myself in the past, I only tend, we usually tend to look for only opportunities for reversals. So you see a market going up. So people see this. And what are they looking for? Well, they're looking, there's a major resistance here. Market is going to fall down. And then they start looking for selling opportunities. So they see a market that is going up, and all they are interested in is opportunities to sell. They're trying to say, this is the highest price. It's going to form a double top. It's going to form a double bottom. But over the years, I figured out something. The market tends to stay in the trend. And more often than not, it's easier if you trade in the direction of the market. So if the market is bullish, while most people are looking at, so people see this and are saying, let's look for opportunities to sell this. Me, I'm not doing that. I'm saying, well, looking at the overall structure of the market, that is based on this time frame I'm looking at, where does this market fall back to before it starts going up? So I'm looking for opportunity to buy because the market is bullish, while most people are looking for opportunity to sell. Now, the thing is this, sometimes, many a times or some few times, you get people find, the market, they will find the tops and then they will make some money. However, more often than not, well, you see something like this happen. So the market is going up, and then somebody sees the market as bullish and say, the market is at the level of resistance or at some sort of order block or something like that, and says this market is going to soon start falling. It has to fall. It's overbought. It's this, it's that. Look at the RSI, look at stochastic. And then you decide to sell. And what happens is the market will just come down a little bit and continue going up. And then you start wondering why you always get it wrong. Well, one thing for sure, at least based on the way I trade and the way I teach, is trade in the direction of the trend. There's a reason they say buy low and sell high. There's a reason they say the trend is your friend until it's broken. That is a factor you want to keep in mind. So since our goal is to trade in the direction of the trend, we want to do our best to identify the trend so that we can decide if we are scanning for opportunities to buy or scanning for opportunities to sell. Now watch this word, scanning, right? This word scanning is very important. There's a reason I say we're not watching for opportunities to sell or opportunities to buy. Why? What's the difference between searching for something and scanning for it? Well, let me give you an example. If you have antivirus on your system, so you have an antivirus installed on your system, and every week or every month, however it is, or every day, you scan your system for virus. What are you doing? Well, you're saying, look at my system, right? And you know how antivirus works, for those of you who might not know, there's something called a virus definition. So it has more like a dictionary of known viruses, right? Not just dictionary of known viruses, but also some features of known viruses and how they might look like. And so it will use that dictionary, and if it gets to any particular item on your system, it will scan it and say, okay, can I find any type of anything that looks like a virus? And if I find that, I will flag it as a potential threat. Now, note that your system, right, the antivirus is not just looking for virus. It is scanning your system, and if it finds something that resembles a virus, then it flags it. Now, what's the difference between that and searching? Now, I'm sure you've heard the statement, within you define, like if you define something, you will see them, right? So if you have a boyfriend or a girlfriend or a wife or a husband, and you suspect that they are cheating on you, like maybe your friend is telling you they are cheating on you, you suspect that they are cheating on you, and you suspect that they are cheating on you. Well, do you know what will happen? Every single thing they do will look suspicious. If they make a call and they are smiling somehow, you're thinking, hey, so you're talking to him or you're talking to her, even though they might be talking to their friend or their mom or their dad. And there might not be basis for it. But you will start seeing confirming evidence. You start seeing things that looks like what you are searching for. So when looking at the market, you want to scan for opportunities as opposed to search for it. So that means when you're scanning, you have rules like the antivirus. You have a definition of what you're looking of what a virus would look like. In this case, the definition of what a good opportunity would look like. And if you find something resembling the opportunity, you would then take action. But what people do most of the time is they just open their charts and they're saying, look at this big bullish market for make money here. And then everything looks like opportunity for them because they don't even have a plan, right? Now, even if you love, let's say you love counter trend trading. So if the market is bullish, you like to look for selling opportunity. If that's what you love, fine. Have a plan as to what you look for and how you trade it. And then you might increase the probability of being right. Because remember, I cannot teach you how to win all your trades because I don't win all my trades. I can show you how to improve the probability of being right and then how to limit the risk to exposure to your account when you're wrong. Now, it depends on the type of trader you are and what time frame you're comfortable with. You might look in terms of, so how some people might ask, so how do I identify the trend? Well, I have a video, there's a training video on market structure. Most of you are traders, so that's fine. You can identify the trend by looking at market structure. Some people can use indicators, or some people might use moving average and say, okay, if the market is above this moving average, then I'll consider it bullish. If the market is below this moving average, I'll consider it bearish. Or if market structure is acting in this certain ways, I'll consider it bullish. Or if market structure is acting in this certain way, I'll consider it bearish. There's no right or wrong way. What you need to figure out is your own way, right? The market is dynamic, that can accommodate all of us. But you need to figure out how to trade the market in your own way, because that's where you be most comfortable and you give yourself the best opportunity of making profits. All systems, I don't trade with indicators, but you can be profitable. There are a lot of people who are profitable trading with indicators because they have a system. And there's some people who trade with indicators. Sometimes they are trading smart money concepts. Other times they're trading price action candlesticks. They're just all over the place and they wonder why they're not making money. So identify the trend, or the first point is define the time frame you want to look for opportunity, identify the trend within that time frame, and then pay attention to, now I'm talking based on my own preferred system, pay attention to counter trend moves in the direction of the markets that you are interested in, okay? Now, a popular saying is buy low, sell high, buy low, sell high. Now, what that means, we all know this, but what it really means is, it means the best time to look for buying opportunity is at the higher low in an uptrend, and the best time to look for selling opportunity is at the lower high in a downtrend. So take, for example, the market is, let me bring my pen. So let's say the market is bullish. So market is making higher highs, higher low, higher highs, higher low. Now, looking at this, we say, okay, the market is bullish, and we say we want to trade in the direction of the trend. Where is the best point for us to look for buying opportunity? Let's say we see the market at this point. Do I want to buy here? Well, no. The rules say we want to buy low and sell high. Well, buying here, is this buying low? No, that's buying high. And what we want to do is buy low. So I would like to watch, if this market is still interested in going up, I'll be interested in buying if the market gives us a low price. So this low price is a better place for me to get involved. And not just is it a better place, it's also less riskier. So for instance, if you had bought here, where will you put your stop loss? Maybe down here. As opposed to, let's say, if you buy here, where do you keep your stop loss? Still down here. You can see that in the first scenario, our risk is just too much. But in the second scenario, our risk is quite limited. Now, here's the thing. Many at times, right? Let me erase some of this. Many at times, price may not come back up or come back that low. And so this is where people get frustrated. So they're saying, oh, look at the system. It taught me that I should buy low and sell high. And what they do is they start waiting for opportunity to buy, right? But then the market does something like this. It comes down and goes up. And like, every time I'm waiting for this, it doesn't happen. That's also something you need to be cautious about, right? Just because you have a system that makes sense doesn't mean that the market will always give you opportunities fitting your system. If you're looking for opportunity to buy here, let's say down here, and the market doesn't get down here and the market goes up, well, you need to understand that this cycle has passed. And then maybe you should start looking at the next cycle so that you don't miss out on opportunities, right? So it's important, it's very important to say, okay, we want to look for opportunities to buy low and opportunities to sell high. Remember, we are scanning for these opportunities. That means if we're waiting to buy low and the market doesn't give us the opportunity, well, we don't trade. We move on maybe to the next day or to the next opportunity whenever it appears. And that's how you trade. You need to understand that a lot of the times, successful trading is about patience. Like there are a number of times where I'm waiting for opportunities in certain pairs I'm interested in, and I don't see them. Like maybe the opportunity doesn't present itself, or maybe when it does, I'm not able to take the trade, maybe because I was doing something else, or maybe I'm on vacation or something. But however the case, I just move on. I'll wait for another opportunity. I'll scan for another opportunity. So waiting for opportunity is also one of the key steps in successful trading. Okay, now so you see the chronological order, right? We define the time frame we want to look for opportunity. We identify the trend within that time frame. We now pay attention to counter trend moves so that we can figure out opportunities to buy low or to sell high. And then once that's the case, we want to define, so if price, so going back to this example where we're saying we have, we're looking for price to come back to a certain area. It could be Fibonacci. So you could draw your Fibonacci and say, look, if price comes back to, let's say, the 61.8 or the 78.6, I want to buy, right? So once you've figured out an area of interest, a zone of interest, what you want to then do is look for confirmation around this interest. Now, confirmation is one of the key, very, very key parts of why people lose money, right? Now, just because in a bullish market, price makes higher highs and higher lows, doesn't mean anytime, it doesn't say that price will continue to go up. At some point, the market will break down. Now, a lot of the times people would say, okay, it's respected me here, it did this here, then it should do this here again. And then let's say they see price coming down, they set a pending buy, and the market just blows past and hits their stop loss. And they're like, what's going on? Why always me? Well, the truth is, confirmation is something that will enable you to avoid, bad trades. Now, even with looking for confirmation or waiting for confirmation, you will still get into trade that end up taking you out for stop loss. But without confirmation, you will take too many trades, and some of them would just be flawed. Now, what can confirmation be? Some of them, sometimes it could be price structure, sometimes it could be price action candlestick, sometimes it could be an indicator. So I'm going to use an example of, let's say, someone who is an indicator type trader and an example of someone who is, let's say, price action type trader. So let me use a price action type trader, for instance. Let's say you trade price actions, and then you want to apply all of the things that we just talked about here. So first time you figured out the time frame, and let's say we're looking at the 1 hour chart, and the 1 hour chart is bullish. So you said, okay, the market is bullish on this time frame, and I'm interested in trading the market. Now you might have one thing you also want to do is do a top-down analysis, so a multi-time frame analysis. This is multi-time frame analysis is a training that I have in some of the advanced courses or trainings that I give. Once you have an account and you funded, you should be able to access those courses. But nonetheless, it's more or less a breakdown, a top-down analysis of price action, right? Now, so you're a price action type trader and you've seen that, okay, the market is bullish, you're looking for buying opportunity. So we said, so let me go back a little, identify the trend. So we figured out the time frame we want to trade. We've identified the trend is 1 hour charts. We want to now pay attention for opportunities to buy because we've identified that the market is bullish. So we want to see opportunities to buy low, right? So because the market is bullish, we are only interested in buying opportunities. We're not trying to sell high. And then we want to look for confirmation. So this is where you now say, okay, well, somebody who's a price action trader says, maybe let's say you're looking to, if price pulls back towards an area, it could be an order block. You might have a leftover order block. It could be 61.8 Fibonacci retracement or 78.6, or even any way you look for you're looking for an opportunity to buy low, right? Now, just because let's say this line here, where's my other pen? All right, let's say this line here is the 61.8, right? So you want to look for opportunity to buy around the 61.8. Now, most people would just, might just set a pending order here and say, well, I want to buy, put a stop loss here, put my targets here. Now, this is also an okay way of trading, especially for people who don't have much time to wait for confirmation. And then in waiting for confirmation, sometimes you would miss some trades, but that's fine. You have to be okay with that. Now, if you place a pending order and the market just continues to slide down, when you come back, you'll see that there was no reaction from price here for the markets to continue to go down or to begin to go up. And then, you'd have just had a trade make you a loss. However, if you try to watch for confirmation within that region, right? So if you try to watch for confirmation of before you get involved in a trade, and then let's say in terms of confirmation, now you are a price action trader, so you're looking for maybe candlestick formation. It could be a bullish, maybe you want to see a bullish spin bar or a bullish engulfing or some bullish candlestick formation to show that price is actually rejecting this area. Now you could have that bullish rejection candlestick become your confirmation. Now note that even with this confirmation, price could still very well hit your stop loss, but now you have further confirmation, right? You have further confirmation that price is probably ready to go your way. And then even if price end up going down and hitting your stop loss, it's okay because you know that it's part of the drill. The market would not always give you 100% success. And your goal should not be to win 100% of your trade. The goal should be to have a profitable system that makes you more money when you're right and doesn't lose that much when you're wrong, okay? And so once you have that confirmation and you get, so it's like saying, so let's say you have I'm trying to look for an analogy. I always like to use an analogy, right? So let's say you have a player, so football, let me use football. Let's say there's this player, Mbappe. Mbappe is a very skillful, very fast player. Now the coach says, we've studied Mbappe and we noticed that during the 70 minutes or 80 minutes, he gets tired. He's unable to run that much. So we can, and it's not because of that, it doesn't track back. So from the 70 or 75 minutes, once you notice that he doesn't track back as much, then you can let us exploit his win. Now, sometimes Mbappe might get tired around 70 minutes. Sometimes he might not even get tired during the match. Sometimes he might get tired around 80 minutes. But you will know he's tired when he starts holding his waist. Now, sometimes when he's tired, he might still track back. Other times he might not. But the sign that he's tired is, okay, he's holding his waist. And so you're now okay to exploit that area. Now, this analogy might not make so much sense, or it might, but you get the drill. Now, the holding of waist is like the price action setup, right? For people who are price action type trader. It could be some sort of structural shift. So let's say on the smaller time frame, price is making lower lows, lower highs, and then it now makes higher highs, and then start making. So this could be the confirmation that you're watching for. This is where Y curve comes into place and all. But the confirmation is necessary to say, okay, this gives me the reason why I'm doing this. And then at least you stack the odds in your favor that when you're at least you avoid those times where the market just blows past and doesn't respect anything. Okay, so that's why waiting for confirmation is important. Now, for indicator type traders, you know, for people, there are some traders who trade based on certain indicators, and that's also very fine. You know, or if it's something that you're cool with. So let's say they look for, maybe they use moving average. Let's use a simple indicator, right? So they use moving average. You know, moving average would move like this. Let's say they use 2 moving average or something like that. And then anytime price comes back to the moving average, they want to look for opportunity to buy, right? Because the market is bullish. Now they might say, how do I know where to buy? They might now use another indicator, stochastic or RSI, and say if price is oversold and the price is also and the market is bullish and price is moving down and price is showing that it's oversold. So this oversold here, the RSI, is now their confirmation to get involved in the trade. And if they find the conditions met, then they might look to buy and take price up. Now, sometimes the market will be oversold and would not go up and will still keep going down, but that's their reason for confirming or how they confirm price movement, right? I hope all of these things is making sense to us. Now, once you have all of these other 4 that we just highlighted out of the way, the next and the most important one of them is to define your risk. Now, I see a lot of people get involved in trades not knowing what they are risking, right? Somebody opens a trade, right? Because they see big push up. They open a trade, 1 standard lot, no stop loss. Well, when you open a trade with no stop loss, what is your risk? Well, your risk is all your account size, right? If your account is $2,000 and you open a trade and there's no stop loss, you don't have an idea of where you want to exit for in case you're wrong, well, you're risking the entire $2,000 in your account. Defining risk, like before I even get into trade, I want to know what I'm going to lose if I'm wrong, right? If you approach the market this way, you would never blow an account. I can guarantee you, I've never said, you know, when people blow accounts, they don't blow the account because they lose small money each time. They blow the account because of one stubborn trade, right? In most cases, it's usually one stubborn trade that blows the account and they keep martingale or keep trying to enter again and enter again. Instead of just cutting the losses short and moving on, they hold on to that one stubborn trade that ends up becoming the straw that breaks the camel's back. So what you want to do is define your risk, accept your risk before you get into the trade. And then once you've defined and accepted your risk, you know that if you're wrong, this is how much you lose. And then you accept that. So you can place your trade once everything aligns and then move on with your life. If you come back and try to hit your stop loss, you already know what you were risking and you've already accepted it. Personally, I don't risk more than 1% of my account on any position. And I usually tend to advise 1 to 2%, right? Now, it's all obviously depends on the account size, but preferably, you know, 2%. So let's say you're trading a $500 account. 2% of $500 or 1% of $500 is $5. 2% is $10. That's fair. Don't open a trade where your risk is more than 1 or 2% of your account. Because now, if you risk 1% of your account in a trade, you will have to lose 100 trades back to back before you blow the account. But if you lose 100 trades back to back without any single win following a particular system, then definitely your village people are after you. But that's a joke. But you get it, Joe. Like, it just doesn't work that way, right? Even a blind person has a 50% chance of being right. Like in the market can only go up or go down, and price can either you can either buy or sell. So once you close your eye and place a trade, you have a 50% chance of being right. Now, if you have a system, this is where system comes into place. At least you have something you're watching for, scanning for, and then you push the odds in your favor to at least make profits. So defining your risk and accepting your risk is very, very, very important. It's actually the most important part. The most important part to how you to your trading system in general. So somebody asked a question, can you please talk about where to place your stop loss? Now, there's no secret to where you should place your stop loss. This is why I've been talking about systems. So you look, system is all about studying previous price action based on some of the things you've learned and seeing how price reacted in the past. So let's take, for example, somebody who is who looks for opportunities like, let's say, buy low and sell high. So when the market is making higher highs and higher lows, is looking to buy low and continue the overall trend. Now, so the person would actually, in this setting, well, if price keeps making higher lows, in a bullish market, price should keep making higher lows and not lower lows. So that means if, let's say, price is coming back down here, and I'm interested in buying, and I find confirmation to buy, I see confirmation that meets what I'm looking for, and I want to buy, well, based on this system, where should price not go below? Well, price should not go below this low. So I can put my stop loss maybe 5 pips or 2 pips or 10 pips below this low. Because if price comes down and takes out this low, it's no more a higher low. It's now a lower low. So maybe we're now in a bearish market, right? Now that's for this system. For someone who's using indicator or someone who trades price action, let's say candlestick formations. Now, let's say you're looking at a bearish pin bar. So you have a pin bar that looks like this in let's say an area of resistance, a strong resistance. You have this pin bar. Now, my pin bar doesn't look like a pin bar, but get it through. Now, you might say, well, usually when the markets show rejection candlestick, price don't usually come back up and close above it. So I can put my stop loss 10 pips or 5 pips above that high and target, a low. Now, where your target is also based on the system. Some people will do risk to reward ratio. Some other people will look at, well, for example, in this case, if I'm looking to buy, I expect that, and the market is bullish, price is most likely going to want to take out this high. So that could be my CP, right? And my stop loss could be down here. But for somebody who, in this case where you're saying, okay, the pin bar price should not go above this high. And then maybe you look at the next level of support and say, if price comes back down to this support, I'll take my profits. So it's all based on your system. And your system is based on what you've looked at price. You've seen price do a certain thing over and over again, and you're comfortable trading that system. You're not trading it because you know it's always going to be right. You're trading it because you know if you stick to the system, your system, because you've back tested it, you're going to make more money out of it than you would lose, right? That's the whole idea, okay? So defining risk is essential if you're going to be profitable in this business. Now, once you've defined your risk, now your risk is also tied to your exit plan. You define how you enter the market. So still in the same vein, say for example, somebody who uses price action, right? Somebody who tries to trade bullish pin bar or bullish engulfing might say, well, how do I enter the trade? You might say immediately, once it's a bullish engulfing or a bullish pin bar from a level of support or something like that, or from the 61.8 Fibonacci retracement, whatever it is that you're looking to trade, you now say, immediately, I want to wait for the candle to close and maybe enter at the open of the next candle, or maybe wait for the market to pull back down, to come back down to maybe 50%. So that's you defining the entry based on the fact that you've looked at previous price action and you're looking to trade the same thing going forward. So you define how you enter the trade. And then once you've defined how you enter the trade, you want to define how you exit the trade. We already talked about stop loss and how you exit the trade for profits in both cases, okay? So it depends on how far. I know many people who trade using a specific lot size, so 0.1. Anytime they open a trade, it's 0.1. Anytime they open a trade, it's 0.2 or 0.25 or something like that. Well, except you're only going after this, you're only risking the same amount of pips. Does that make sense? Otherwise, it doesn't make sense, at least to me. So let's say I'm taking a trade and my risk is 20 pips. And I don't want to risk 1% of my account. I don't risk more than 1% of my account. And let's say my account is $10,000. Now, 1% of $10,000 is what? $100. That means my stop loss, if the market goes against me and hits my stop loss, I shouldn't lose more than $100. Now, if my risk, at least based on my system, let's say I'm trading, I'm looking to buy low, and I don't expect price to come back down to this low here, right? And this is where I find the confirmation to enter. Now I'm trying to enter here, but the gap from here to here is 20 pips, right? Well, the reason is 20 pips is not because I decided 20 pips, it's because that's what I see on the chart. If I decide to trade with the standard lot, how many, and I lose 20 pips, how many dollars do I lose? Or $200? Is that more than my risk? Is that more than 1%? Yes, that means I'm not going to use the standard lot. But if I use 0.5, right? And I lose 20 pips, how many dollars do I lose? Well, I lose how many? $100. So that fits into the 1%. And then I can say, this is the lot size I'll use. Now, if I want to take the next trade and my risk is 5 pips, I can afford to use one standard lot. Do you understand? My lot size is varying based on what my risk is, not the target. Many of the time, people look at, oh, I want to make 5 pips. So if I use one standard lot and it goes in my favor 5 times, 5 pips, I'll make $500 or something like that, or $50. So they forget about it. They're not looking at the risk, they're looking at the reward. But then when the market doesn't go their favor, that's where they now start crying and like, why did I do that kind of thing? Okay. So your end, depending on how far close your lot size, your stop loss is, it should have a bearing on what your lot size, you choose. Now, the last and most important point is write down your system and follow it. Now, this is the most important part. I don't care if you write it down. If possible, write it down on paper, on a book. And anytime you want to trade, keep it by your side so that you know that this is what I'm following. So saying, this is the opportunity, this is how I look for opportunity. This is the entry criteria. This is my risk parameters. And this is how I exit. If I don't find a condition that meets this criteria, well, I'm not going to get involved in the trade. And then you follow the rules. If you have a beautiful plan and you don't follow it, it's rubbish. If you having a beautiful plan that is not followed, it's just bullshit. It's better to have a not so beautiful, not so good plan, and you follow it strictly. You probably make more money than someone who has a beautiful plan and doesn't stick to it. So write down your system or the rules for your system and then follow it. So here are the key takeaways. Have a plan. It's essential. Having a plan is essential for achieving trading success. A trading plan should be written in stones, basically. So stones, not necessarily. It should be written down and is subject to re-evaluation. And just because you have a trading plan doesn't mean you don't try to improve it. But what you should never do is adjust it while trading. So I see some people, they place a trade and they put their stop loss at a certain place. Now, as the market begins to move and it seems he wants to hit their stop loss, they'll now say, look at, I missed this. No, that's not the resistance level, it's this one. They'll now adjust the stop loss. You should not adjust your system because in a live market condition. If you want to look for a better system, look for it outside live market conditions. And then if once you're comfortable with it, document it down and then trade it in live markets. Now, a solid trading plan considers the trader's personal style, your personal goals. So it's very important because what works for me may not work for you, and what works for you may not work for me. Now, knowing when to exit a trade is just as important as knowing when to enter. So your exit parameters is very important. And then your stop loss prices and profit targets should be added to the trading plan to identify specific exit points for each particular trade. So now we've come to the end of this, obviously the slides and this particular session. And now we'll jump over to live market and just, try and see if we can put this into perspective and see if we can look for an example or for an opportunity, and that we can apply something of what we've learned. Okay. Now at this point, I will. Okay, so now we'll jump over to live market examples so that we can see if we can piece together and apply the concept of what we just learned about building a trading plan based on our own system or based on our own personality and looking to follow that plan irrespective of what happens. Now, so I'm going to just use, just as an example, this is the chart for Euro USD, the most popularly traded instrument in the market. And we're going to just try and trade based on, we're going to try and trade based on, let's do trading based on Fibonacci. So we want to trade based on Fibonacci. Now, first point is we want to identify the trend. Now we've identified that we're swing traders, so we're looking at daily charts. We want to identify the trend. Now, if we go from this point here, so let me draw my chart. We go from this point here, here, down here. You see that, well, the market is bullish, right? So the market is bullish all in this region. And from this low here to this high, that was the last swing the market made. So this was this. Let me just delete this. So this low here is what caused this high. And as a matter of fact, during this period, it's okay for us to be looking for buying opportunity. So take for example, right now in defining your trading system, you should also factor into place where to partial out. So you want to maybe take partial profits. You might want to move your stop loss to break even, right? And it's very important. My trading system is very robust, or my trading plan is very concise and very robust. I have rules as to how I take partial profits and how I move my stop loss to break even, right? Now, those are personal to me. You have to define what is okay by you. Now, let's say, for instance, in this scenario here, the market is bullish, right? So you can see the market is bullish. Now, let me use the replay tool in this instance. And let's take this out. So the market is bullish. And how do we know the market is bullish? Because we can see it. What can we see? Well, it's making higher highs and higher lows, right? Making higher highs, higher lows, higher highs, higher low, and a higher high. So this is the most recent high. And based on the bullish market, what are we expecting? We're expecting price to continue going up. Now, somebody who is an indicator trader might maybe use moving average and add, let me see if I can add that. Add 2 moving averages and maybe let's say a 15 period moving average and a 20 period moving average. And if price is above it, might use that. So let me see if I can add a moving average. So I'm just trying to show you an example for in both cases. So whether you're an indicator type trader, a price action type trader, I don't really care. Just have a system that you follow. So let's use the exponential moving average, and let's say use a length of 50 and for okay. Let's use 50 also. Let's click OK. And then let's do the second one. And let's also make this exponential. And let's make this 100. Right. Let's change the color to red, white. Okay. And we're good. Oh, what do I do here? Okay, let's make this red. Okay, so now somebody who uses, let's say, moving average might look at this and go, well, prices are above the moving average, so this is a bullish market. You can see price is staying above the EMA, and so an indicator trader says, well, this is what I would consider a bullish market. Now, why I'm showing you this way is, I don't really care what type of trader you are, as long as you've back tested it and then you've looked at it and you're comfortable with how it works in the past. You know, there are some people that trade moving average crossovers, right? For instance, crossover here, they'll use that as a reason to buy. If that's your strategy, fine. Just have a rule around it and trade based on that rule. Now, I'm not going to use indicator. I'm just going to delete this and delete this, but you get the drill. Now, we'll see that the market is bullish. And this is the low, this is the high. Now, in a bullish market, we expect price to continue to make what? Make higher low and higher high, higher low and higher high. So if price wants to start coming down, we should expect price to make a what? Higher low and still go on to make a higher high. So market trends we've identified. We're looking for watching as the market is trading counter the trend, and we're looking for opportunities at certain areas. So let's say we're using Fibonacci and we want to trade if price is within the 61.8 or the 78.6. So we draw from low to high. And so we identify the areas we are interested in buying from. So let's say from the 61.8, right? So here, so down to 0. Now, what this means is, remember, one of the points there is that we want to wait for confirmation. So we want to look for confirmation within this region. So we've done the first part, we've done the second part, we've done the third part. Now, confirmation. So what it means is we're not just placing a pending buy here, a pending buy here. We want to see price get here and have a reason to buy. So now let's see price move. Let me make this 3. And so price begins to move. And many times price might not, let's say price doesn't come back here and begins to go up. That's fine. Understand that as it changes, as the structure change, if let's say, so in this case now, right, down here, it might be possible that we're expecting, so let me use the fib again. This might be our fib that we drew out from low here to high, and we might be expecting price to come back down to the 61.8 or the 78.6. Now notice what happened in this case. Did the price come back down there? No, it didn't. So we might not even take the trade here because with the criteria we're looking for, the market did not give us. That is fine. We understand that once the market has broken above this area, it has now put in a new higher high. So this is our new low, this is our new high. Again, we'll possibly wait for another retracement here like so, right? And then watching to see price come down to the 51.8 or 61.8. And what happens? Well, in this case, price does not come down here again as well. It's also fine, right? Out of 3 trades or 3 times you're looking for opportunity, it doesn't happen. Now, in this case, price is also coming back down. And let's see. So price comes back down. Let me zoom in a little bit. And does it tap into that area? So now price taps into this area, right? So price taps into this area. And then this is where you now start waiting for, okay, how do I get involved in this trade, right? If you're looking for, let's say your confirmation might be something like, maybe you're looking for a bullish engulfing, you're looking for price action candlestick, or you might even look for Wyckoff schematics within this area, within this structure. And then if you find the opportunity, you get involved. Now, let's say, for instance, in this case, you're looking for a setup to buy. You're looking for price action, maybe a bullish engulfing, or you want structural shift. So a structural shift here might look like this. So price, you can see, so this is what I call a counter trend. This is the overall trend, bullish. But look at this inside structure of bearishness, right? This is the inside structure of bearishness. Overall bullish, but this inside structure is counter trend, the overall trend. So if the market does something like this, then you see we've shifted trend and we can look to get involved. So this is basically kind of how Wyckoff schematic works. But let's say we trade based on a bullish engulfing, right? You can see there's some sort of an engulfing bar here, and we get involved with a buy. Let's say we buy at the open of this candle. And now this is a rough sketch. You should have qualifiers, things that qualify your trade. So for example, I won't take a trade if the risk to reward ratio for me is not at least 1:4. I don't take trades less than 1:3, 1:4. 1:3 very rarely, but at least 1:4. But let's just say, for the sake of this, we're buying. We know that this is the low price, and price is most likely going to want to get here, right? Otherwise, you can be something like maybe if we get involved here, we can keep our stop loss here. But let's just keep it simple. A price begins to move, and let's see what happens. Well, okay, so price, you can see how price came down within our area. Does it give us? So now you see something. The reason we kept our stop loss here is because, well, this is the based on the structure we're looking at, and we're looking at this target. Now, the goal of this is not showing you this strategy, go and trade it exactly like this. You can apply the same concept on a lower time frame, and at least it will reduce your risk and probably give you high potential reward. Some people would say they don't trade, they like to trade the 78.6 because this way it reduces their risk and increases their reward. It doesn't really matter, right? It's just sometimes the market may not fall down that deep. And then also you want to have reasons as to how you exit your trade. So for example, if the market begins to go your way, you want to have an exit plan as to how you move your stop loss to break even and how you close partial profits, right? Now, in this instance, let's say as this happens, we maybe move our stop loss to break even like so and keep it there. Maybe take partial profits at this high, but price begins to move. And something I want to show you here. Now, let's assume we take a loss on this trade, right? Because price fails and breaks down. I want this thing to move faster. Let's make it 10x. Okay, so you can notice something here. At this point, the market you take a loss. You can see now you should have probably taken profits off here. But notice what happens. The structure of the market is also changing. So this is why paying attention to the market is quite important. This was the low and this was the high. Price is expected to make a higher low and also make a higher high. But what did price do? Well, price made a lower high, right? And has now made a lower low. Because this here, because this here was the previous low and price has now made a new low. So right now, it seems the market structure is changing from this bullishness to being bearish. And once we see the bearish market, what are we looking for? Selling opportunity. So actually, at this point here, where price went below here like this, that could have been an opportunity for us to start looking for selling opportunities, because now the structure of the market seems to have changed. And we can now ask ourselves, what's high caused this low? This is the overall high, but this low here is actually the one that caused this low here. So we can take our Fibonacci, right? And go from low to high like this, I'll be high to low. And let's say place a sell. So we're going to be a sell in this case at let's say 618 or let's say 786, but our stop loss is going to be up here and our target will be down here, right? So you can maybe in this is where you might decide to break up your trade, take your first trade at 618, take your second trade at 786, something like that. And you can see in this case, the market went on, hits our profits. Let me just move on faster because I think this class has taken too long. But you get the whole idea. The market is bearish, at least based on this time frame we're watching. And what are we only looking for? Selling opportunity. This is the new low. We draw our Fibonacci. So let me delete this. Maybe draw our Fibonacci from high to low. And we are waiting for maybe opportunity to sell around the 618, put our stop loss here, and keep our targets here. So we have a rule as to what we are watching for and how we want to get involved. Sometimes the market doesn't give us an entry. And other times it gives us a beautiful entry and we make a lot of money. But then we understand what we're watching for. Now, what I explained here is a very simple concept. If you want to try something like this, you probably want to use it on these 1 hour charts, maybe 30-minute chart, 1 hour, 4 hour chart, because sometimes in a daily chart, the market doesn't always pull back or retrace that. But you can see if we keep drawing our fib, low to high, it pulled back. You see the market kept making on. The market has not made a higher high. It has just been making higher lows. So if you've been trading the fibs, well, you'll just be making profits. But why? Because you're looking at it based on market structure, right? If you're maybe using moving average or any other indicators, maybe you'd have been, because you understand that the market is bearish, you'll be looking for overbought conditions to sell, or something of the nature. But that is about having a system and how you trade it. And you can see we'll just keep repeating the process over and over again. This is our new high to low. We watch to see retracement, another high to low. We look for retracements, another high to low, and we watch for retracement. So you can see we have a plan. Sometimes we don't get involved, sometimes we get involved, but we stick to the plan as long as the criteria or conditions are met. You see another high to low here. And you can see good trade here. It's 61.8 pullback, another trade here. As well. So at some point it will fail, like it always does, you can see in this case, and watch what happens. So at this point now, the markets, let me delete all of this. I think it's not too much. Let's delete all this. Now note what happened here. The market has broken above this high. This is the most recent high based on the overall bearish structure, right? This high here is the most recent high. In breaking this high, what does this say? Well, it shows that it seems bears are losing control of this market and buyers are most likely going to take price up. Well, if that's the case, we start looking for buying opportunities, right? Now, you can have this overall outlook, right, on a daily chart, and then go down on a smaller time frame, let's say a 4-hour chart or a 1-hour chart, and look for Fibonacci trading or Fibonacci setups on in direction with the overall market condition, right? In direction with the maybe looking for buying opportunities. And that's how you look for these opportunities. Now, I know this class has taken quite too long. I think we're down to half our size, or 3/4 of the size. But I just wanted to use enough time to explain the concept of what successful trading really looks like and how you build a system that you watch for. You can see how since price broke above this high, we now entered a bullish market. And you could see inside structures that you would have traded within this area, looking for buying opportunities that would have allowed you to trade in the direction of the market, which is now bullish as price moves our way. Okay, so I think that's the much that I will take for this session. And then I'm sure you have questions. If you have questions, please put them in the chat box below.